Welcome back. And IT is obviously the flavor of the week. Let's quickly pull out the Nifty IT index. It's cooled off from the day's highs, so that is evident. But let's also pull up the two earnings candidates within that Nifty IT pack. So 0.25% lower on the Nifty IT. We're languishing at the day's low. TCS absolutely flat, maybe slight positive bias. And then there's HCL Tech, of course, 1.7% lower on an HCL Tech, mind you. The numbers were decent. In fact, it was a beat on both revenue as well as EBIT. In fact, revenue grew 6% versus last quarter and much higher than what analysts were penciling in. Profit obviously dipped on the back of that one-time charge, 956 crore, due to the labor code implementation. We caught up with C. Vijayakumar, who is the CEO and Managing Director, and CFO Shiv Walia, to understand what's the way ahead with regard to the IT major. Listen in.
I think the demand environment is quite good because we have delivered an exceptional booking of $3 billion in the last quarter. We've signed a couple of big deals, one mega deal as well, and our pipeline remains quite robust. I think traditionally, service providers were looking for discretionary spend in the pockets which we were always used to go and address the discretionary spending of the clients. But I do think that has shifted a little bit from the traditional discretionary spend areas to more AI enabling areas. And that's where we have seen a strong traction and a strong growth last quarter, and even the Q3 has been contributed by those discretionary spend areas we've been consciously going after. And that's very closely linked to the big CapEx cycle that's happening in the overall tech industry.
You've announced or disclosed an advanced AI revenue of $146 million. Do you see eventually all your clients have a bundling AI as part of the entire service offering, and this revenue pie is going to increase on a very faster scale?
Yeah, it's grown about 20% quarter on quarter. Even in the previous quarter, it has grown very well. So we are already at a 600 million annualized revenue on advanced AI. And I want to clarify, this advanced AI is somewhat different from general AI, which we talk about. Like, we have AI implemented across 60 plus customers for a very large footprint of our clients. We are leveraging AI. But that's not what we are calling out as advanced AI. Advanced AI is certain kind of specialized services like AI data center build, the professional services around that. And similarly, we are building custom silicon for edge inferencing for a lot of customers. There is physical AI, robotics. It is these services which we call out as AI services, which is also growing very fast. And I see a strong growth momentum for several quarters to come.
Shiv, come in here. I mean, EBIT margin of 18.6%, but still you're maintaining a margin band of 17 to 18%. Why is that?
Yeah, basically, this is a seasonally strong quarter for a software business. So we delivered almost 35% EBIT in our software business, though it's only 10% of our business. So there is always a peaking in the December quarter on the margins. But if you take a full year, we are going to be between 17 and 18.
Okay, Shiv, what was the impact of rupee depreciation in this quarter, and wage if there's a wage increment which came in here?
Yeah, so the rupee depreciation impact is around 40 basis point this quarter, and the wage hike impact is 80 basis point in this quarter.
And despite that, you've been able to increase the EBIT margins. So where did the gains come from?
So as I said, as CVK mentioned, this is a seasonally strong quarter for us for software, and that is what contributed around maybe majority of the uptick in the margin in this quarter.
Vijay, if you can also give us a sense of the environment with respect to, and the competition with respect to cost takeout deals which is happening. The general perception in the market is that as cost takeout deal increases, there's a hyper competition which will come in and impact margins. How are you seeing this space?
Yeah, I think we do see some of that in some pockets, but most discerning seasoned technology buyers are constantly looking for what value they're able to derive out of a client, of a service partnership, and how do they really build a long-term win-win partnership. So most large companies uh, do understand that we need to build a win-win relationship. There will be some pockets where there will be some kind of very, very aggressive pricing that we might see from some providers. But we are very conscious, right? We want to build a strong, profitable, growing business. You've seen our margins have been in a stable range, 18 to 19% for a very long time. This year, only because of a certain restructuring costs, we are delivering 17 to 18. And other than that, we are very conscious where to really participate and where to walk out of the deals as well.
And how do you see international business growth? Because I was reading some reports and they are indicating that the growth in international business has been slow and gradual. Is that the right way to look at international growth?
For us, entire business largely is international. 97, 98% of our business is international business. And so pretty much the entire growth rate that you see is international business.
Shiv, can you also bring in this entire, the cost, additional extraordinary expenses that have come in because of the labor code? Can you explain why it has been taken and what could be the impact going forward on your margins?
So this is the one-time true-up cost because of the impact of new labor codes, which has come into play because of the definition of wages, which has come into play. So we have taken a one-time charge of 109 million in this quarter. Going forward, we expect a minimal impact of this, maybe at best 10 to 20 basis point per annum.
And the other restructuring cost, will that be, what will be the total cost for that?
For that's the kind is specific to this year only. As we have indicated last quarter, it's going to be around 50 basis point for the full year. This quarter, it was around 80 basis point, and we expect this to be in this similar range in next quarter also. But our endeavor is to complete this exercise in Q4 so that we start the next year with a clean slate.
Vijay, you mentioned earlier that the traditional discretionary spend or this order book is now transforming into little value-added services, which is going forward. How do you see that happening in some of the key verticals like a BFSI or a manufacturing or tech?
Yeah, I think these are traditional verticals, and so I think the newer discretionary spend is significantly happening in the tech industry, which is again a very large business for us. We've grown 14% year on year on the tech vertical, and the creating custom silicon is an area which a lot of industries are looking at, which is much more across the industries like retail, industrial. All of them are looking at certain inferencing solutions which require custom chips, especially large firms. And that's again a big area for us to focus on.
How do you look at the BFSI space? Are you seeing some kind of softness there?
BFSI has been a very strong vertical. We've grown 8% year on year. So we've had an industry leading growth in this segment. And we continue to see good uptick. This quarter sequentially a little softer because of the seasonality related to the December holidays. Otherwise, it's one of the fastest growing verticals for us.
And between two geographies, US and UK and Europe, how do you see both these geographies, on the whole performing?
Yeah, I mean, US, we continue to see great momentum. Europe is a little bit soft, but the rest of the world is doing very well. We've grown very smartly year on year across the rest of the world portfolio. And even India business is growing very fast, though it's still a little small part of our overall portfolio.
Shiv, if you can also give us a sense of, You said you're maintaining a margin of 17 to 18%. I hope it's it's factoring in all the costs which you have done, right, for the full year.
Yeah, it includes the restructuring costs. That's really part of it. But the one-time labor code related costs are excluded in that.
And just to take it forward, I mean, if you go into FY27, because these one-time costs are behind you, is there a chance that this EBIT margin, which is around 17 to 18%, can inch up towards 18 to 20%?
Yeah, certainly. That's our expectation because this one-time cost won't be there. And our margins, we expect it to inch up to our normal band, which is 18 to 19.
Give me a sense of how the ER&D business is also doing, because that did go pretty well in this quarter as well.
Of course, yeah, it's grew 3+% sequentially and more or less 10% double-digit growth on a year-on-year basis. We're also seeing a lot of this newer discretionary spend across industries, which is where the ERS business is gaining momentum.
And when you talk about $3 billion of contract value in this quarter, which is a significant jump versus last year, if you can give us a color of these contracts, which areas and which sectors where you got these contracts from.
Yeah, so the 3 billion, we called it out yesterday as well. 63% of this booking comes from our digital application business and engineering and R&D services business. And it cuts across all the verticals. Very strong momentum in retail CPG, very strong momentum in financial services, momentum in telecom, and manufacturing as well. Life sciences has been a little soft. In terms of geographies, it's dominated by the US, followed by Europe and rest of the world.
Finally, Vijay, if you can give us a sense of the employee net, it has fallen quarter on quarter and year on year, if I'm not wrong. What is the kind of employee addition strategy that you have now? Are you now targeting only skill sets which are digital and AI while adding employees to your workforce?
So from a year-on-year perspective, our people count has increased 6,000 plus people from the December last year to December now. Of course, sequentially, it's been more or less flat or a mild decline. So our employee addition will be very closely correlating to the revenue growth momentum. Of course, there is going to be certain AI-led productivity and a lot of contracts moving from time and material to more outcome-based. That might not have the same increase in people count. So we believe we will deliver at least 4 to 5% growth without having to increase our people count. But if the growth, of course, goes to high single digits, then our people count will proportionately increase.
Vijay, as you get more and more orders which are AI-led and AI embedded, there is always this fear of revenue deflation which is coming into play. How do you plan for that with your marketing and sales team?
Yeah. So I think it's definitely revenue deflation is bound to happen. In all the existing services that we deliver, we can deliver much more efficiently with much higher productivity. So now we have a playbook to really address the revenue deflation due to AI, which is really to look at much broader market addressable strategy, which is really reflected in our growing bookings. And the second aspect is completely new revenue streams, which were not there, but it is really following all the very large capex spend that's happening in the overall tech industry. We've seen a lot of software and hardware investments. Of course, that will also result in significant services, and that is the services that we are going after.